Warren Buffett's favorite indicator as to whether the stock market is cheap or expensive or fairly valued. Guys, it's flashing a warning sign. What's it say? What should you do? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, or smash that thumbs up button. There's sort of two schools of thought when it comes to investing in individual stocks. You can either be a growth investor or value investor. I'm oversimplifying, guys, but growth investor is someone that's loved Tesla even while they were losing money. Someone that was buying stocks, believed in the company, even though that company was losing. I did lots of videos on Tesla and the valuation of it during the pandemic because it was an unknown, but that stock was growing significantly. The stock value, the market value of the company was growing significantly, even though the company had not made a single penny. They'd been losing money and all sorts of stuff. That'd be a growth investor. That'd be someone that says, doesn't matter about today. This company has potential. They're going to be growing in the future. Versus a value investor is someone that is looking at the financials of a company and saying, gosh, based on their cash flow, based on their price to book, based on the balance sheet, this company is pretty strong. And yes, I believe in their potential. But when you look at how the stock is priced, gosh, this company is a good value. This company is actually worth more realistically than what it's trading at on Wall Street. That's a value investor. Most famous value investor of our generation, Warren Buffett. He learned from the greatest value investor of the generation before him, Benjamin Graham. So when Warren Buffett talks about the valuation of the overall stock market, you tend to listen. Well, he said something after the tech bubble that has it's just gotten people's attention so much so that they call this the Buffett Indicator. And this is Warren's oversimplistic one measure. He said it was the single most important factor or indicator as to whether the stock market was cheap, fairly valued, or overvalued. I'm paraphrasing there. And he said that after the dot-com bubble. And so since then, lots of people have looked at this Buffett indicator to get a sense. Is the market cheap? Is it fair valued? Is it expensive? Now, in an overly simplistic world, you might say that the right strategy would be when this indicator or when indicators say the market is cheap, that's when you should buy a lot. That's when you should really aggressively invest as much as you possibly can. When these indicators suggest the stock market's fairly valued, well, just continue to do what you've been doing, but maybe that's not a time to get very aggressive with your investments. But then when the indicators suggest the stock market is expensive, that's when you should pull in the reins. Maybe stay the course, but reduce risk a little bit, and that's not a time to invest a lot. Well, guys, that's altruistic. There's no way that any one indicator is that reliable, number one. And number two, there's another famous investment saying that says the stock market can remain irrational longer than you can remain solvent, which means stocks can stay overvalued way longer than you can afford to say, I'm not investing in that, I'm not investing in that. Case in point being 2000. Alan Greenspan, Federal Reserve Chairman, said that stocks were irrationally exuberant. So disconnected from reality. They are way too high. It's too optimistic. He said that in 1996. The tech bubble didn't even burst until the spring of 2000. This indicator, it's nothing to say, okay, this is gospel here. I'm going to completely change my entire investment philosophy based on this. However, it is helpful to tune in to get a sense. Is the stock market cheap? Is it expensive? Where does it fall? Well, guys, take a look. I shared, it's flashing a warning sign. It's flashing a warning sign. What is the Buffett indicator? It's a ratio of how big is the overall stock market compared to the overall economy. So it's the ratio of the total value of the stock market divided by the total GDP. And it doesn't look at an absolute value. Instead, this chart, as you can see right here, is looking at, well, on average, over the past 75 years, what's that average ratio been? And then where do we stand today compared to that long-term average? And you can see that during the tech bubble, we were at that 2 standard deviation, so significantly higher than average. During '08, and you can't really see it here in this chart, there's some text that's covering it, but during '08, when no one wanted to own anything, profits were falling, stock market had collapsed, yep, you would say that stocks were undervalued at that point. During the mid '80s and leading up to the '90s, where we had that huge boom, stocks were undervalued. Well, take a look at what happened right before COVID. Right before COVID, this channel, several other folks were saying stocks are borderline expensive here. So just be prepared. We haven't had a recession in a long time, hadn't had a bear market in a long time. Just be prepared. And had, caught everyone by, no one was predicting a pandemic, but the pandemic led to a significant drop, one of the sharpest drops in the stock market in history, and it never even got cheap. That 30% decline in a matter of weeks, the stock market never even got cheap. And because we printed $5 trillion, it went from not even cheap to significantly overvalued. And so almost all of 2021, yes, make sure you're taking the right level of risk for your overall financial situation, but now's not a time to get excessively greedy here. The stock market seems to be overvalued, so watch out. Well, we saw that pull down in 2022, and the stock market losing about 18, 19%. At its worst was down about 26%. That also didn't make the stock market cheap. And even though just about everyone and their brother were saying, well, this year for 2023, I would expect the first half's not going to be that great, but it will probably bottom out in the second half and we'll start seeing things rebound then. Everyone was wrong. So we've had earnings, corporate earnings or GDP, there hasn't been explosive growth here, but yet the stock market has rebounded significantly. So once again, this Buffett indicator, this indicator of, well, is the stock market cheap or expensive, is back to flashing, guys, things are pretty expensive. Now, is that just one measure, or are there other signals or indicators suggesting the same thing? This one's my personal favorite. This is a chart put out by JPMorgan Chase, and it talks about the actual price of a stock today compared to the projected or the future earnings of that company. This is based on the S&P 500 in aggregate. So it's the forward-looking or projected current price compared to projected or forward-looking earnings. So because the stock market is a leading indicator, because it moves before the economy, that's where this ratio of comparing today's price to expected earnings, that's a better measure than comparing today's price to reported earnings, the traditional PE. So the forward PE, take a look at it. You could almost overlap it with the previous chart. It says essentially the same thing, although not quite as extreme. This is going back 25 years. That middle of the road is that average forward PE ratio of just under 17. And there you can see we were wildly above that during the tech bubble. We were wildly below that during the great financial crisis. And after COVID, yes, COVID didn't even make things cheap. And after COVID, things got expensive very, very quickly. Well, it's come back down. You could argue that even after that 20% or so decline last year, stocks hadn't gotten cheap, but they are a little bit more attractive now, so that's good. Well, after we solved the debt ceiling, or solved, that's funny, temporarily postponed the debate on the debt ceiling, and inflation at least feels like it's coming under control, and the Fed isn't as aggressive with raising interest rates, the stock market has felt like, well, listen, all clear. And they're bidding prices up, even though there's not a lot of earnings growth happening or projected to happen just yet. Back to this measure, it's showing now stocks aren't dangerously overvalued, but they're approaching overvalued. Okay, guys, so what do you do with this then? Well, to me, you shouldn't look at an indication of whether the stock market's cheap, expensive, or somewhere in between to fully influence and dictate what you should do with your investments. You should be a long-term investor, but this suggests, well, put your seatbelt on. Make sure you're wearing a belt and suspenders. Make sure that you're not taking too much risk. Make sure that you rebalance to ensure that you've got the right allocation. Okay, tune into your overall financial plan to see, okay, am I on track, or does the economy and stock market from here need to be perfect in order for me to hit my goals? And then I would consider multiple investment strategies, hedging as an example, or some other investment strategies that if we do see the stock market bouncing around in this range or surge higher or as this momentum continues over the next 6 to 18 months, but then have another falling out, have another significant bear market, which is very possible that your overall financial situation isn't dashed on the rocks, as well. So making sure that you've got multiple investment strategies as well. Work with your certified financial planner. This is not the guys panic or pull everything out, get concerned. No. Setting expectations and then just that double check too. Yep, is my seatbelt on? Do I have the right investment allocation for my overall financial plan? Am I taking the right level of risk? Do I have the right strategies and diversification in play here? Okay, now I'm ready for if the market continues to rebound or if we do see a flattening or another decline, you're prepared. Work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.